afternoon and welcome to BizTech Asia's Midday Market Watch on Monday, the 13th of May. The year is flying past. I'm Jeffrey Halley and along with my co-host today, Samantha Voon, I'd like to welcome our guest, Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank in Singapore. Vishnu, welcome to the show.
Hi, Jeff. Hi, Sam. Thanks for having me on. Always a pleasure to be here.
Let's see if you're saying that by the end of the set. Okay, let's do what let's start the show as we normally do by looking around the price action on Asian markets, and then we'll get Vishnu's thoughts on that. And it's a fairly muted day in Asia today. We can see the Nikkei 225 is down at 0.38%. Shanghai is almost unchanged, just down 0.08%. Hong Kong's Hang Seng has rallied by 0.69%, the best performer in the region today. Meanwhile, in Australia, the S&P ASX 200 is down 0.25%. South Korea's Kospi has fallen by 0.37%, while Singapore's STI index has climbed by 0.23%. In Kuala Lumpur, the KLSE has also climbed by just 0.18%. Vishnu, what are your thoughts on today's pretty muted price action?
Well, I think it's safe to say that there's some caution in the markets. I mean, for a start, we've had pretty mixed data out of the US. And at the very least, there would be some concerns about US consumer sentiments not holding up. That's been, and that caution probably resonates closer to home, where China's aggregate financing data also came out softer, suggesting there isn't enough credit being created to backstop and to fuel the 5% self-sustaining growth target. So for those reasons, I think markets are going to be quite muted. Of course, the headlines haven't helped with the 100% tariffs on Chinese EVs by the US, casting a long shadow. And surely, if inflation in the US is slightly hotter, I'm not sure how long equity bulls can carry on unfettered at the prospect of the Fed not cutting soon enough.
So, Vishnu, right? We saw a weak consumer confidence data out of the US on Friday, and also equally weak lending data out of China over the weekend. Are we starting to see cracks appearing in the global economy? And also, should investors start taking more cautious stand on the equity markets, like you were saying before?
Given that I tend to be a bit jumpy, I would certainly be cautious, but maybe investors have a stronger stomach than that. But to the question of whether we are beginning to see the cracks, I think the fair statement here is, we're not yet sure. For one, we do realize that part of the US consumer sentiments taking a knock, at least that partly stemmed from higher gasoline prices. So gasoline prices have been heading up over the past few months, and that's correlated to US consumer sentiments taking a step back. So at the very least, investors would need to reassess the narrative of US exceptionalism and how that will hold up in terms of earnings, so on and so forth. So at least we need to reassess the buoyancy that equity markets are enjoying derived from the US exceptionalism story. As for China, I think the problem is we're trying to distill down what the two-speed economy means. I think on one hand, the industrial recovery in China continues apace, particularly from a very soft base. And of course, we are conveniently ignoring whether there'll be a broadening of the trade tensions with the US after the tariff announcement, so on and so forth. But China continues to struggle with the confidence deficit we see on the ground. The weak credit data are certainly not going to help the fact that both consumer and investment sentiments remain weak, looking for some kind of stimulus and some kind of offset from the central government. So we've watched the policy space pretty closely, but surely there are reasons to be cautious, even if we are not imminently alarmed about cracks.
So Vishnu, let's stay with China and the aggregate, quite tight aggregate financing data that we've seen as implied by those falling loans data over the weekend from Chinese lenders. Is this going to renew conviction or finally shift the needle for the PBOC to either ease policy rates or for central governments to increase stimulus? And in that case, are we actually also looking at a weaker Chinese currency as well?
You make a really good point on that one. I mean, on one hand, the PBOC will surely be cognizant and more acutely aware that the credit stimulus in the economy may not be as broad-based as they want it to be. We did see that a lot of the tightening came through in the so-called shadow banking sector. And so they'll be mindful and perhaps a lot more targeted in trying to stimulate either by cutting MLF rates or by putting or coaxing some credit quotas to expand lending. But then we come to the other point that you mentioned, which is the renminbi. So in favor of renminbi stability, there's a trade-off. They can't overstimulate and over-ease in terms of cutting rates. Otherwise, it would jeopardize the stability of the renminbi, and that could cost them dearly. So the prohibitive cost of holding the renminbi up will also weigh into the policy decision, which is why we think it'll be fairly balanced. We could, I think, reasonably expect more triple R cuts to come through, some targeted credit push to come through. But for the time being, it is not going to be unbridled in terms of the stimulus measures by the PBOC. So it's not, no holds barred kind of easing, primarily because the countervailing objective would be to ensure renminbi stability, particularly amidst buoyant USD yields and a strong dollar.
Well, Vishnu, we have a rough of inflation data due out this week, but mostly close watch will be the US prints, starting with Fed inflation expectations tonight and also the official inflation data on Wednesday. What are you expecting, and also how might this impact markets?
I mean, that's going to be a tricky one, Sam, because I think on one hand, there would be hotspots in the details of the inflation data. So really, for the hawks looking for reason to bristle and fret over sticky inflation, they're not going to have a shortage of those sticky spots to fret about. But equally, I think if we look at a broader trend basis, there's no reason to believe that disinflation has been stalled indefinitely or worse, reversed. And I think the longer run inflation trajectory would also be one where rentals start coming off. So on a more durable fashion, we should see disinflation resuming and at least stabilizing further down the road. The last aspect of this is that I think, and to your point, which is this week's data might give the hawks and the bond bears more reasons to double down on what they're betting, which is the Fed can't cut now. Inflation is too hot, so yields need to be high. But for anyone putting it together with the wage picture, which is softening wages, then it becomes quite clear that the Fed's response function can start to ease up. They need not hold policy so tight because the wage increments are not feeding into and feeding off the inflation print. But that's probably going to be for someone who takes a considered view. And I think this week is not a time for that kind of introspection. It's just, knee jerks and let's get the party rolling kind of bond bear market. So that's something we want to be mindful of and wary of.
And speaking of knee jerks, let's look at dollar yen. So after the alleged intervention from the Ministry of Finance over the last week or week and a half, dollar yen has climbed back up to just shy of 156, but it seems very reluctant, looking at the charts over the last few sessions, to actually peek its head above that level. Are markets reluctant to take dollar yen higher here because they are worried about more potential intervention? And if we do see firmer US inflation data this week, could we actually see the authorities out again trying to hold dollar yen down?
That's a good one, Jeff. And I love how you properly use the word alleged to frame the market intervention. So let's just say intervention risks remain high If we look at the yen, in particular, the yen crosses, the yen remains pretty weak against the crosses. That's to say, even taking into account some of the dollar adjustments we've seen, yen hasn't quite gained as much traction as the dollar yen would lead us to think. So there are two takes here. One is, which is the point that you highlighted very well, that is, if inflation does go higher, it leads USD yields to go up. That's probably going to see dollar yen. That's probably going to incite some upside in the dollar yen. That I think is something we need to remain mindful of, and intervention risks remain live, even if they're not imminent. And so the risk, the point here is, in an opportune moment, if speculation is excessive, we should be quite wary of intervention risks, and that remains on the table for some weeks to come. It's just not in the rearview mirror yet.
It looks like they are going to try and keep currency markets honest then. Thanks very much for joining us today, Vishnu. As ever, it's been insightful and a pleasure.
Pleasure is mine. Thanks, Sam. Thanks, Jeff.
We've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley.
And I'm Samantha Voon.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms, and also with our syndication partners, TV stations, radio stations, and websites. Remember to like and subscribe, and thanks so much today for tuning in.